It is Thursday, February the 22nd. We're running up against the end of February.
Already.
Amazing.
We've had this week Fed minutes come out, and those Fed minutes have reconfirmed that the Fed is pumping the brakes a little bit, and they are going to, surprise, they're going to get inflation down to 2%, and they're still going to do it.
I've heard that before.
Yes. And they believe that there will be rate cuts, but it will be the second half of the year.
Remember, we started the year with people saying we're going to have 6, and some of those would be before the mid-year break, and then suddenly now we're talking 1 or 2 in the second half of the year.
And then to contrast that yesterday,
is that we've had a stark jump from where we were, say, 2 or 3 weeks ago on the 10-year Treasury, which, if you remember, for the first time in a long time was below 4%. Now it's up to 4.35%. And I know those numbers are kind of nerdy, but that's a big jump in the bond world, and it just continues to reinforce that the Fed is getting exactly what it wants without them having to raise rates. The 10-year Treasury goes up, which means the mortgage rates goes up, which means the credit card interest rates go up. Everything is tied to the 10-year Treasury.
Brian Westbury came out this week and said that with those increases in rates, summarizing what he said, but tying it to those rates, if that's going to go up, that ultimately is putting pressure on consumers, and you are beginning to see consumers slow down in spending. An anecdote. I do the grocery shopping at our house. I enjoy doing that. I went into the grocery store this week. I did not buy anything exuberant, but I did enjoy Christy. Got Christy a bottle of wine, and we had steaks last night, but nothing big. And we do go out twice a week in most cases. So it was a full grocery cart, but it was not a big grocery cart. In excess of $300.
Oh, that's a lot.
And I didn't buy things that were exuberant, and I just thought to myself, that can young folks, especially folks that are in the more fragile economic positions, that's a difficult thing to do.
Well,
so slowing down is what we're beginning to see.
They were using, like most people, debit cards to pay for groceries, and now with what we've seen at grocery stores, they're now using credit cards, which is different because they don't have to pay it right then and there. They can spread it out, and what's happening is these credit cards are getting weighted down with a lot of credit.
We talked about in our show just before that we went off the air that we do believe your statement was that the S&P 500 is going to be up this year.
Yeah, I do believe that. I think we'd be remiss if we didn't say it's not going to be near 26% like last year. I think if we get above 9% on the S&P 500, I think we will have really accomplished a lot.
I am going to be meeting with some clients who are asking good and appropriate questions. Can our portfolio grow more? Could we get more of that increase in opportunity? And the answer to that is yes. But the answer to that being yes must be added. We got to be in the stock market. We got to have risk, and you got to be willing to stay in the stock market even through the ups and downs in order to achieve where we need to be by the end of the year.
And the stock market is not acting evenly. I mean, we've got, as we've talked about, 7 stocks carrying today. 50% of the S&P 500 is actually in negative territory year to date, while the stock market has had a really good first 2 months.
We would tell you that the bond positions, that moving out durations, we've got the majority of everybody's money in the 0 to 6% world. We got a small piece in
0
the
to 6 months.
0 6 months, 0 6 month world. We got a small position in a liquid mutual fund that's buying 3 to 5 year term high quality corporate bonds. That's liquid. We can get out. You aren't stuck in there for 3 to 5 years. But we're kind of on hold with that because of exactly what's going on in the 10-year getting higher at this point in time.
Right.
So we're doing that. We are continuing to buy into the market on a slow pace. We're doing that. We're reviewing all the accounts. We're reviewing cash positions. So we know that you want us to be active, and we are being active, but I would say prudence is where we still are.
Yeah, because I do expect a paring back in the market, and then that would be a great sign for us to put even a little bit more to work.
All right. So if you have any questions, any concerns, anything you'd like to talk to us about, give us a phone call. If there's any of your friends or neighbors who are saying, hey, I don't know what to do, we'd love to meet somebody new. We're growing gratefully because of you introducing us to folks. So please continue that. We do this each and every week because we know it is your money.
And your money matters. Talk to you next week.
See you next week.